So today we're going to talk about how do mortgage brokers make money. So I'm Money Mentor Meg, and I'm the founder of Collab Companies, which I created for real estate industry professionals because I'm on a mission to disrupt the mortgage and the real estate industry by helping those of you real estate and mortgage professionals realize that inner entrepreneur so you can take control back for all the hard work you've put in and have a lasting and meaningful impact on the people around you. So my job today and in this video is to help teach you the different ways that you can make money in the real estate industry so that you can have this self-sustaining business that supports you in any environment, no matter what part of the industry you're in, understanding how to add additional income streams. And so we're going to dig into how mortgage brokers make money. Because if you've worked at a mortgage company before, even for years, you know the commissions that you get, but you might not fully understand how the money works or flows if you were the one controlling the money. So we're going to walk through what the flow of money looks like, and then I'm going to break down two scenarios in the mortgage broker model and how money flows through the hands of the owner and the loan officer. So I'm going to bring this up on my screen here for you, and we will go through it. So how do mortgage brokers make money? So it starts here with a loan officer. And a loan officer, once a business is up and running, that loan officer is on the front lines and they are talking to customers, they're negotiating, they're getting contracts, they are deciding with a client what loan is best going to fit what that client needs. And what happens here, number one, is basis points, BPS, BIPs. So when you are a mortgage broker, it's a little different than if you've worked at a lender or a bank. At a bank, you're typically, here's what our rates are. You might have a little wiggle room. You have to ask permission. If you're at a lender, you look and you are going after that par rate, 100. You're looking to get as close to 100. If you're under 100, you have to ask for that exception. In the broker space, it's a little bit different. You have more control and you get to see all the pricing. And there are two ways that brokers pick the rate and what the company makes. We're not going to dig too far into that, but what we are going to do is just really follow the money and how it works. So you get what's called basis points. And number two here, and I apologize, it's a little bit small, but hopefully you can see this. I'm going to tell you what it says. Number two is, as a loan officer, you typically are going to make somewhere around, I put 75 basis points to 250 basis points. If you are a loan officer, you don't own the company. And bear with me if you're in a model where you get all 275 basis points, I understand that, and then you pay expenses. We're going to walk through that. But typically, as a loan officer that works at a mortgage brokerage, you're making 75 to 250 basis points. And that means that you either have a traditional commission model, or if you have a branch model, that's when you make more basis points and then you cover your own expenses. But once you make that decision here based on what your company's rules are, you're going to lock a loan in. And that lock is with the next party over, the mortgage broker owner. So that mortgage broker owner has set the company up, they've signed up with banks, and there are agreements that this is what this mortgage brokerage is going to make, but there's a way in the broker world to alter how much the brokerage brings in and how much the loan officer makes by a little bit. And the broker is the one, the broker owner receives the checks, number one, after the loan closes. So the broker receives the checks. And then number two, that broker owner pays the loan officer the compensation amount that's in that loan officer's contract. So going back over to the loan officer, they pay them that 75 to 250 basis points, let's say. Now, one good thing to note is that brokers are maxed out at how much they can make on loans. So number three under a mortgage broker owner is they can't make any more than 275 basis points. Bear with me here because I have two more images I'm going to bring up, and we actually go through an example with a loan and calculate the actual math and how much the checks are. So a broker can make a maximum of 275 basis points. So then that's how they figure out and what they offer to loan officers based on how long they've been doing this, how much business they do. So the mortgage broker is the one who gets the check, but it's really the loan officer on the front line working with clients and negotiating the amounts that are going to be coming in on the day of closing. Now, where does this money come from? Well, the mortgage broker owner has these agreements that they've put in place when they started the company with wholesale lenders, and wholesale lenders put agreements together with mortgage broker owners, and the wholesale lenders, number one, they pay the mortgage broker owner, the mortgage brokerages. Number 2 and 3 are the two different ways that mortgage brokers get paid. It's really the same thing. It's just two different ways of doing it. It does get sometimes a little confusing for new people in the industry because there are these two ways, but all that means is there's choice and there's flexibility with how you lock a loan and how you can serve a customer. Then the wholesale lender works on that loan, underwrites it while it's getting approved up until it's cleared to close. And then once the loan is ready to close, it's the title company that is the party that is going to get the money on the day of closing from that wholesale lender. And the title company, number one, they charge their fee for managing the transaction at the end. And number 2, they receive the wire, the amount of money at closing. They get the buyer's money, the buyer's responsible for bringing, and they get the wire from the wholesale lender, and then the title company or attorney will then distribute the checks to all parties that are involved and who are due money. So now let's go to our little compensation orange bubble on the right. And I've got here number 1, when you have compensation as a mortgage broker. Like I said, a loan officer locks a loan at a lender, at that wholesale lender. Number 2, the lender agrees to pay a specific amount when the loan closes. So you go into a lock agreement. So if you've been in lending, this is all making sense. If you've never been in lending, when you're a loan officer, you lock a rate, and it has the amount that you are going to be paid. Just like when you go to the stock market and there's a price that the stock is selling for, you're going to be buying GE stock for $1.25 on a certain day. You lock that in. That isn't going to change. That's an agreement that you make. And that agreement is good in the mortgage world for 30 days, 60 days, 90 days. So you will look as a broker between different lenders to see what rate they are offering each bank and that are paying you the amount that you're looking to make as a company. And then number 3, on the day of closing, the lender sends money to the buyer and through the title company and the agreed amount that the broker has negotiated. So let's go to the actual example here that breaks down the numbers. Oh, good. This is bigger, so it's a lot easier to see. So let's say that you are a loan officer that works at a mortgage brokerage. So I'm giving you the aspect here from the mortgage broker owner and the loan officer. So let's say you have a client who's buying a house for $250,000, but the loan amount is $225,000. The buyer's putting $25,000 down. So just to have a reference, if you're locking a loan to make 100 basis points, that means that there's $2,225. That's going to be coming to the brokerage at closing. If it's 200 basis points, then that's $4,450 at closing. If it's 275 basis points, that's $6,187. And so that's how there's a difference in how much can come in. There are a right way to do this. There's a right way, a wrong way. There's the two different ways. But let's walk through the dollar amounts here. So let's say the mortgage broker company owner who has the agreement, the one who's going to receive the check, let's say that this loan gets locked at 275 basis points. So at 275 basis points, that means that the check that is going to be dispersed to the mortgage broker company on the day of closing is $6,187. That's how much comes in. And then what happens is once the mortgage broker receives that check, deposits it into their bank account, now they need to pay out, number 1, the loan officer who created that loan and closed it. So let's say the loan officer is getting paid 125 basis points, which is a strong commission in the mortgage industry. So 125 basis points means that loan officer is going to get a check for $2,812. So they will get that check. This is more of a traditional commission model. The loan officer's not paying for the expenses. In this case, after that check's written to the loan officer, the arrow goes over here to where it has expenses of 100 basis points. So now the mortgage broker company has to pay all the expenses because they've negotiated with the loan officer. This is their commission split. Now the mortgage broker owner has to pay expenses. So I used an example of a mortgage brokerage whose expenses average out at about 100 basis points alone. So meaning they have to pay out $2,250. That would be things like when they buy computers, office supplies, the benefits, health insurance, 401k matching for that loan officer on their check that they got. That would be the support staff that they have there. So they're paying out all of these expenses and the loan officer. So what happens is, how does a mortgage broker owner get paid? Because they are a for-profit company with whatever is left over. So let's go through the math again. The mortgage broker receives that check for $6,187. They pay the loan officer $2,812. They pay their expenses of $2,250. That means that the mortgage broker, after everything is paid, has $1,125. If they have loan officers that work at their company and that are producing closing loans, this is what would be left over in this scenario. Now, every scenario is different though, so keep that in mind. Not every loan gets locked at 275 basis points. The expenses of the mortgage broker are dependent on the decisions that that mortgage broker owner decides to make and pay, and how they, put their business together. I'm going to show you one other model that is common in the retail world, and it is common also in the broker world now. So let's go to my next example, which is more of a net branch model and pay. So it's the same exact scenario, a $250,000 house, same loan amount, same BIPs you see there, same check that the mortgage broker owner is receiving. But now the difference is, I used an example where, let's say you as the loan officer are getting 200 basis points. So at 200 basis points as the loan officer, that means you are getting a bigger check, $4,450. So you get that bigger check. But now you'll notice that you as the loan officer have other expenses. You've got the office supplies. If you're going to have a assistant, if you're going to have support, if you're going to have any of those other things, you're going to have to pay them. So let's stay in our yellow boxes here, go down. And if a loan officer is paying their own expenses, it would be things like they'd have to pay for their credit report pulls for the month. So I used $500. They would be paying for their health insurance. Let's say that's $350. Let's say they're paying for some part-time support, $250. They're paying for supplies, rent, another $500. And so what that means is that the loan officer has to pay those expenses. And so after paying the expenses I have on here, the loan officer is making $2,850 on that loan. So how a loan officer can make more money in this model is the more loans they close with the expenses staying similar, they're going to make more money. If you aren't closing 3, 4, 5, 6 or plus loans, you're not going to make more money. You're going to probably end up in a lower check scenario if you aren't consistently closing 5 or more loans a month. Now, let's see what happens to the mortgage broker. So the mortgage broker owner, now, yes, they're paying a larger amount to the loan officer. So let's say that mortgage broker now doesn't have the same overhead. They still have some. They have some things they need to still pay for their overhead. So let's say it's 10 basis points. They pay $225 alone as their expenses of what they handle, passing most other stuff off to the loan officer. So that means that mortgage broker of the $6,187 is writing the check to the loan officer for $4,450. Then they're deducting and then they're writing off the $225. So now they're getting $1,512. It's just two different ways. There's no right or wrong. It's just two different models. And so it really just comes down to the consistency of your business. But hopefully this has helped any of you that are wondering, how does a mortgage broker get paid? Or if I go to a mortgage brokerage, like what are the different models? Or what if I own a mortgage brokerage? Like what kind of money comes in? And this will show you the flow of money, how it goes through, so you can figure out what the best scenario is for you, for what you need, and for where you are in your business. So I hope that this helped. And if this is your first time here on the channel, make sure you subscribe, hit that bell so that you don't miss any of our other videos that are for any real estate, mortgage industry professionals, how to grow your business, understand, lean into that entrepreneurial spirit. We will be back next week, and you can check out some of our other videos that walk you through all the different intricacies of owning a mortgage brokerage and the other businesses in this industry.